you can do it that way. Nothing wrong with that. You're just going to make a lot of mistakes, and those mistakes are going to cost you a lot of money.
Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Hello, good afternoon. Thank you for listening in to the Mornings with Joel CRE podcast. Excited to have Ken G with us today, and he's going to be sharing with us some very, very insightful information related to the commercial real estate industry, specifically multifamily. And his background actually serves as a basis for why we thought this conversation would be very insightful. So we're excited to have him with us today, and we're happy to have you listening in. And so, Ken G, welcome to the show. How you doing today?
I'm doing great, Joel. Thanks for having me.
Absolutely fantastic. So, Ken, you've had an extensive background. You're not a kid. You've been around the block a couple times, and you started off in commercial lending, from what I understand, and then you went into CPA work, and now doing what you're doing. So, give us a little background on yourself as to why we could view you as a voice to listen to as it relates to what we're going to talk about today in commercial real estate.
Yeah, so I can tell you my story, or I can just tell you where we've come.
Tell me the story.
Yeah, all right.
Hear it.
So I grew up in Toledo, Ohio. Got my undergrad at University of Toledo. Moved to Cleveland. Went to school at night for my master's degree at Case Western Reserve. That's when I was a commercial lender. I spent 5 years as a commercial lender there, and while I was going to school at night to prepare myself to become a CPA. Mission accomplished, became a CPA, worked for Deloitte for 7 years on the tax side, did a ton of private equity work, a lot of merger and acquisition, due diligence, tax planning, all that really cool stuff. It was there that I decided, well, actually what happened was, I want you to rewind the clock. I had a lot more hair back then. This is almost 30 years ago. The kids were young. I used to do my daughter's middle of the night feeding. Super cool time if you're a parent. Father-daughter time, you can't get any better than that. And it was cool until I realized it wasn't cool. And I realized, wait a minute, man, I just did everything right. I went to school, got good grades, got a great job. I was living large, right? Until I realized my family was going to grow up without me because I had no control over my time.
Yeah.
And it was just rough. Being a CPA is rough. So I spent about 18 months trying to figure out the multifamily business. I'd been surrounded at the bank with people that were making a lot of money in real estate. At Deloitte, there was a huge real estate tax practice. And so I wanted to figure it out. Did that, bought 3 deals, a 28 unit, a 24, and a 22 unit, and sold them 3 years later, made $500,000, and felt like I was the richest guy in the world. I couldn't even imagine having $500,000 in the bank at the same time. So, fast forward the clock now. We've done 20 deals, gone full cycle on 14 of them, done a couple $100 million in deals, and our management team has managed over 16,000 units. So, big jump between then and now. But real estate is all I do. Now I'm in control of everything that I do every single day. And so that's kind of my story really quick.
No, I like that. I like that. That was a very, very insightful breakdown as to how you put that all together. Let me ask you this more specifically. How do you think your background as a commercial lender, because obviously you were on one side of the table,
Yeah.
you jumped to the other side, and also your background as being a CPA, how do you think that's really contributed to your knowledge as it relates to making sure that a deal makes sense as opposed to one that shouldn't be done?
Yeah, when I was at the bank, you learn the risk mitigation, you learn credit, you learn how to work out of deals. You just learn from the viewpoint of the person putting in most of the money. That's the lender. How do you protect yourself? So it really helped me identify risks, figure out how to analyze them, mitigate them. And then, my CPA time at Deloitte, obviously I got really good at numbers. Tax is a huge part of why people do real estate.
Right.
And I would say my exposure, our firm is now a full-on private equity firm. That's what we do. And my exposure to that whole industry while I was at Deloitte was massively helpful because, we raise money, so do private equity firms. We buy assets, so do private equity firms. We do the exact same thing. We just do it in real estate. They do it with businesses, companies, right? Our properties are big enough to be businesses, but you can see it really, I would like to tell you that it was a grand plan that I put together years ago, but I didn't. Okay. It just kind of happened. And I think it's, really, really helped us be successful as a company.
All right. Well, fantastic. And yeah, it makes sense. It looks like you really put the pieces together in order for it to happen. And like trying to read a book on how to swim, you just can't do it, right? You have to be in the trenches and
Well said.
understand, yeah,
Yes.
understanding both sides of the table is vitally important. You often have made the statement that there's a better way to create wealth. What do you think most investors really don't understand as it relates to creating wealth through real estate? And most people like to stick with single family homes, and they think that that's the path forward. What would you say to those individuals?
Yeah, so back in the beginning when I was trying to figure out how I wanted to get into real estate, I was trying to figure out singles, doubles, four families, and here's what I couldn't figure out. I couldn't figure out how I was gonna get from point A to point B with these single family homes. I just couldn't because what they were selling for had no relationship to how much income they generated. I
Right.
mean, that's not how you value single family homes. It's based on what your neighbor sold for and everything else. I'm like, "Man, I can't figure that out." The second problem I had is remember I was working at Deloitte,
Mhm.
working 70, 80 hours a week. The last thing I had time to do was to go unclog a toilet in the week. I just didn't have time for that.
Yeah.
So, it's not that I don't know how. I probably would destroy the toilet, try to do it. I am clueless when it comes to that stuff. But here's what's important. I had to find a way that what this real estate was gonna bring in enough money that I could hire people to do the work, that I could really run it like a business.
Mhm.
Okay, that was really important because I mean, my life wouldn't allow me. I had 2 young, very young children, a wife. I mean, I mean, how was I gonna squeeze more time out of my day, out of my week? And so that's why that was critical, and that's what led me to multifamily. I've never actually owned a single family investment house, never in my life. And so now when I watch people do it, what they I mean, multifamily is in real estate in general is a longer term get wealthy plan. It just is. And my saying about there's a better way to create wealth, it's because most people are trying to find these quick hits, right? That's not what multifamily is. If you just keep at it over a really long period of time, I mean, it can grow massive wealth, right? So go back to my single family world. I watch people do this and they make money on each house, but it's not enough to actually matter, right? They make 20,000, 30,000. Now, you're like, "Ken, that's ridiculous. That matters." Yeah, but it's not change your life matter,
Right,
right?
right,
I
right.
mean, if you buy an apartment building and you make 2 or $3 million, that
Yeah.
matters. I
That
mean,
that
that's
can make
changing the game for you.
change for you. Yeah. In
You
your
know what I
life.
mean? So all this blood and sweat has a real result and an impact on your life.
Yeah, you bring up a couple of points there, and you didn't actually say this, but the connotation was there, and it relates to time, right?
Mm.
We all have the same amount of time during the day, so I can manage, 10 single family homes and all the headaches that come with that, or
Well,
I could handle, at the same time, one apartment building that would pay me a whole lot more money and to give me better results. And
and you don't do as much work.
there you
That's
go. Right, and that is key, exactly. Now, with you saying that, what have you found to be kind of that magic number as to how many units you need to have under management in order to have it fully staffed and not have to do the amount of work that the average person would have to do with a bunch of single families?
yeah, so, I mean, the perfect number in our world is 100 units, but now let me said remember I said I bought a 28, 24, and 22 unit.
Mhm.
See, what I find happens with people is 100 units, $10 million. There's no way I could put that together, right? That's what happens. That's what goes on in people's minds.
Right.
So nothing wrong with starting with 20, 25, 30 units. You have to get a little bit creative about how you manage that. And there is money there to
Mhm.
staff, right? The bigger you get, the easier it gets. But in the beginning, what I found happens with people, and we help people figure this thing out, right? Is that they have to get their mind trained that I can buy a 25 or 30 unit. I find that in many cases, unless they're, being mentored and coached by somebody who understands how to do this, they can't figure out how to put the partners together and how to develop all the relationships and all that, right? To get 100, 150, 200 units.
Right.
It does, right? Because most people don't have a lot of money. I always tell people that sit in my chair in the beginning, people always think they have money. That's why they're doing apartments. That is dead wrong. The people that have a lot of money, they give their money to people like me and us to do it for them.
Mhm.
So almost everybody starting out of my chair has no money in the beginning. They get creative about how they bought that first property, right?
Right.
That's what I did. I borrowed my half of the down payment on my home equity line, right? I didn't write a check. I got it off my home equity line. And then I partnered with my then in-laws. So it was us and them, me and them. See, I got creative. That allowed me, I literally had no money in the bank, but I had this line of credit that I drew on and borrowed the money. Deal number 2 came a little easier, deal number 3. So you just kind of get creative out of the gate. And what I find people do is they just, back in when I did it, that property was 575,000. Now that property, is probably a little more than that, but they can't wrap their head around how to get that money to do the deal. And if they get creative and just that's the key to getting into this business. And that's the number one thing I find stops them.
Yeah. Yeah. No, it's a very good point because that is the A and B part of it. Most people say, well, I could come up with, whatever it is to buy a single family, so I'll start with that.
Yep.
And that's the mistake. It's like you said, it's all about getting leveraging your resources, time,
Yep.
relationship, things of that sort. We call it friends and family
Yep.
in the industry, in order to pull that together. So that's very insightful. And that's encouraging too, that you've actually done it without, because everybody might look and say, okay, well, he just had a golden spoon or a silver spoon in his mouth.
Oh no.
And so,
Oh no.
yeah, he's not telling us the real story. But,
No,
and
if you saw the house that I grew up in, I did not know rich people. We did not. I had a fantastic family. My parents were awesome, but they were not rich. I did not know rich people. Every investor relationship that we developed the hard way. And if you look, I mean, just look at all the successful people. Most of them, they didn't start off with a golden spoon in their mouth. They started off with nothing and they figured it out. And I'm here to tell you, most people that start off in my chair, they don't have money either. And it's not like, here's the good news for your listener. It's not like you're going to be a unicorn. There are thousands of people that have come before you. This is a really solvable problem that I spend a lot of time on every day trying to help people wrap their mind around how to solve that problem. Because once you do, you're like, oh my gosh, I can't believe I just solved that problem. Because you can, trust me. You're not a unicorn. There's no reason you can't do it. You just have to figure it out.
The Impact Air 99. We asked real people, try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
welcome back to the show. We really appreciate what you've been able to share from the standpoint of how you get from point A to point B. And there's a lot of us, even a lot of our listeners, are corporate executives in commercial real estate, and they're doing a job, they're getting a paycheck, but they're not actually on that wealth building side from that standpoint. You can make a lot of money in the executive chair, but also, the ownership side is a different animal. From having that job and quitting it to the point of, being able to do that. So I appreciate those insights that you share. Let's talk about this, though, because you made the comparison earlier about a CPA firm and what you were doing there and businesses and the stock market and all this. Why do you think commercial real estate, multifamily in particular, needs to be in everyone's portfolio?
Well, I'll tell you why. It's the only thing I do, and we do multifamily. And here's why. I can't figure out how to make it go away. If people don't need a place to live,
Like bigger problems.
we got huge problems and nobody's caring about money anymore, okay? So if I'm able, here's how I rationalize this. A relatively low risk thing like multifamily, everybody can understand it. It's easily understood by investors. Most people have lived in an apartment, been around them. They understand it. They get it. It makes sense to them. It's something that we need. And if we can implement a value add business plan that intentionally, we call it forced appreciation, but we're growing the income of that property so that it's worth more. And if I can deliver 15, 20, 25% annual returns on a relatively low risk asset, like how do I not do that? Like I can't figure out how to not want to do that. Right. Like, I mean, we could do crypto, we could do the stock market. It's volatile, goes up 1,000, down 1,000. I mean, that's a roller coaster, right? That's just not how real estate works. So that's why I do what I do. I mean, we could do office, we could do medical, we could do retail, but we intentionally only do multifamily because the risk aversion in me wants to make sure that I have as safe of an asset as I can have. I can't say it's safe because it's a business and have this upside associated with it. That's why we do multifamily.
Yeah.
And I have some control over that.
Mhm.
Because if I can raise rents $200, $300, $400, right? So if you don't mind, I'll give you a quick example of what I call multifamily math. You got 100 units and you raise rents $300. Let's pretend, okay? So 300 times. So now you fast forward. You held this thing for 5 years. It took you 5 years to get there, right? So now it's worth how much more? 300. It's valued based on its ability to generate new cash flow. 300 times 12 times 100 units. What is that? That's 360,000. I'm doing some quick math in my head. I think that's right. When I divide that by how we value multifamily, that cap rate thing, if I use a 6% cap rate, which is pretty reasonable in today's market, you've got $6 million of new value. That's just 100 units over just 5 years. And all I did was move rents, for $60 on average, right? Well, if rents are 1,600, that doesn't seem like a lot. All right, so maybe it's $200 instead of 300. Well, now I just made 4 million. You see, and if I sitting in my chair put in 50,000 and then got the rest of the money from investors, that's a lot of money for me, right? That's a lot. I mean, that's why people need to figure this out, right? That's how private equity works. That's how hedge fund guys work. I mean, but the big money in this business, if you're sitting in our chair, is that bonus that you get if you do a good job.
Right.
And in most cases, it's at least 20% of the profit. Well, imagine 20% of 6 million, that's what? $1.2 million. I only put in 50. Dude, how do you not want to do that?
Yeah. Yeah.
I know I went kind of fast, but my point, this is true. I mean, we do this all the time. And this is why people are fighting to get into this business. And this is why pushing through and figuring out how you're going to get into business is so insanely worth it, right? Do it right. And that's why I do what I do.
Yeah. Yeah. No, very, very good analogy. I do want to talk about one thing because I want to be realistic with the audience as well. We talked about, the side, the benefits and everything else. Let's talk a little bit about the downside. And I'm doing that with you because of your background in accounting and banking and everything else.
Yeah.
Come from a risk mitigation standpoint. What could go wrong with commercial real estate, with multifamily, and how do you mitigate against that, for an example? How do you fix problems? 'Cause
Yeah.
I don't know where you're buying in the cycle. Are you buying value add, new construction? So let's talk about that. I don't want to throw things at you at once, but you know where I'm
Oh,
going.
you got, I got you. No worries. So, we need a value add component to all of our deals. That we insist on that. And we buy new construction, but we think there's value to be added. Well, how do you add value to a brand new building? Well, do you know how builders lease up? They discount. They give you 3 to 4 months of free rent and they heavily discount. I buy it off the builder. They're renting below market. All I have to do is turn those leases and get them to market, right? That's value add through management, okay? You don't always have to tear the place down and rebuild it. You don't have to tear the place down and rebuild it to add value. You just don't have to do that. So what could go wrong? Well, interest rates could go way up and cap rates go way up. Okay, that could be a problem. Insurance could go way up. That could be a problem. The neighborhood could deteriorate. That could be a problem, right? There's a lot of things that could go wrong. So how do you mitigate all these risks? Legitimately learning the business from somebody, I got you back, from somebody who understands the business. But here's the number one thing that is critical. You have to know that there's some upside in rents. So most of our properties we won't buy it unless there's $200 to $300 a month in upside over 5 years.
Okay.
And by having that discipline and legitimately doing the homework to make sure it's there, new cash flow solves all kinds of problems. Insurance goes up, that's all right. Rent's higher, I can afford it. Did interest rates go up? That's okay. I can afford it because I raised rents, right? So the way to mitigate this is to learn the business, do it right, do your homework up front, and make sure you're only buying properties that have this upside because now you have new cash flow that you didn't have before. That's how you mitigate all these risks. So we buy it all. I mean, we've been doing this for so long. We went through 08, 09. We went through COVID. Right now, we're in a part of a cycle. I mean, doesn't matter where you're at in the cycle if you follow that formula. Now, is it best to buy at the bottom? Of course, But I mean, we don't have the benefit of a time machine that we can look ahead 5 years and then go ahead 5 years and then look back and say, was that the right time to buy? We can't do that. We don't have that. So if you maintain this discipline, it almost doesn't matter where you're at in the cycle. The challenge is maintaining that discipline. Because when you're trying to get into this business, you hear this guy got a deal, she got a deal. Oh my gosh, I need to get a deal. And you get FOMO. You know what FOMO is? And people laugh at me because FOMO is fatal. Like there's no cure. It is worse than cancer. It is worse than COVID. Once you get it, you're done. I mean, you're done. There's nothing you can do. You just have to not get FOMO. But it's really hard because you really want to make that money. You see? So that's how you mitigate all that.
Yeah, no, good point, good point. And so it's really understanding your numbers and like you said, can you get that upside appreciation? Because that's going to determine everything from that standpoint. So as an investor, you did and really it's across the board, and I can certainly understand that because we've looked at assets where a builder is just like, I can't spend the time leasing this up. I got to get rid of it. So it can be a brand new asset, especially in infill sites, or it can be, another type of opportunity. Are you normally looking at C grade properties, moving them to B or move B to A, or where do you normally fall in the ratio there?
Yeah. So let me tell you the life cycle of somebody that sits in my chair. Typically, you start off with value add C minus properties because they have the most physical improvement needs and so on, right? That's
And
just
potential in some cases.
right. But well, yeah, but not more. Here's the thing about these deals. People early on in their career, they want to make money. They need to make money, right? So they need to buy, add the value, leave some to the next guy, and sell and turn that capital over and over. Because here's what it does when you're sitting in my chair early in your career. Proves to investors that you can do it. Investors love giving you money. They love it even more when you give it back to them with profit. Then they reinvest with you, right? Now let's fast forward, right? Now I'm giving you my story here, right? Over time, what happens is I don't need to make money. I'm good, right? But I do want very much to create long-term wealth. You see, early on, you're probably buying older assets and typically the older the asset, you shorter the hold period you want it to be, right? Because you don't want to hold something 50, 60 years old for a really long time.
No,
Something probably is going to go wrong.
right.
But now I'm creating wealth because we're buying very high quality assets in great areas that are distressed right now because of sellers' interest rate situations and builders who don't want to run them. They want to just build and sell. So we're getting good deals on those and creating long-term wealth. So rich people want to create wealth. People starting out want to make money.
Right.
See how what happens is you transition. Now, some people stay in that making money mode forever. That's okay. There's nothing wrong with that. It just dictates what kind of deal you buy, right? So now, if I can, here's how really like insane wealth is created. You buy a property, rents go up, you refinance it, you pull the money out, you give it back to your investors. Now you all got a free apartment building because you got nothing in it, and you go buy another one with that money. And then you run it, you refinance it, you take your money out. Now you got 2 free apartment buildings, and you go do it again. This is what rich people do all the time. They're building these assets. So now they've got, an asset appreciating like it was. We have a deal we bought with $7.5 million. It's now worth 20. Our investors had their money out a long time ago, but this asset just keeps going up in value. They got nothing in it. They probably turned their money twice since then. You see how now it's creating massive wealth.
Right.
Does that make sense?
Oh, absolutely. Yeah.
That's the life cycle of somebody that sits in my chair.
Yeah. Yeah. No, it makes good sense all day long from that standpoint. And like you said, it's a progression, where you're moving from the C to D. So I get it. So really in your spot right now, you're looking at more, maybe not necessarily trophy assets. You can certainly look at assets in greater areas, nicer
A
areas.
class. No, we're looking for A stuff. Yeah.
Okay. Okay.
Yeah.
all
We're
right,
looking for A, B plus at the lowest. Yeah.
Okay. Okay.
Because we want to hold it for a long time.
Right. Right. So you're at
Buy it,
you're
get
saying
the
you're
out,
doing that.
keep it going.
Right. Okay.
Because you could hold a brand new deal 10, 15 years.
Yeah. Yeah. Easily with no problem.
Yeah. You're not going to have massive problems, or you shouldn't, at least.
Right, right, exactly. Yeah, I wanted to ask you also about something that you always say, and that's about being all in on multifamily. I think you pretty much answered that and made it pretty clear. So what do you think is the thing that's really holding investors back now? Is it just a matter of them trying to do it themselves? Do you think they should get with a firm like yours initially in order to learn the ropes, or what's your thought on that?
Yeah. So, I mean, look, there's nothing wrong with learning the way I did. 30 years ago, 25 years ago, there was no coaching programs, no mentoring programs, no YouTube, nothing. I mean, I learned off of Carlton Sheets cassette tapes in my car.
Carlton
Okay?
Sheets cassette tapes. I think
There
you
you
used to
go.
host some of those out.
Did you? All right. Yeah. Yeah.
I know all about it.
No down payment system. Yeah. So, I mean, that in apartment association meetings. Well, you can do it that way. Nothing wrong with that. You're just going to make a lot of mistakes, and those mistakes are going to cost you a lot of money, and it's going to take you a long time. It just will.
Yeah.
Now, we do the education side of our business. Why do we do it? Because is it fair? I've probably learned a lot over 25, 30 years, right? Well, what if I could stop you from making all those mistakes that I did? I can really compress time for you and get you to your goals a hell of a lot faster. See, that's why I think, and I do this with my own business and my own personal development. Find someone who is where you want to be and learn from them.
Yeah.
Even if it costs you money, like it's money well spent. I spend money on that stuff for me and our company all the time. Because why do I want to go try and figure it out myself? I mean, it's going to take me 10 times longer. Like, why would I do that? Doesn't make sense. So that's what I think is the right thing for people to do. Again, you don't have to figure it out on your own if you want. It's just going to take you a very long time. And then the other thing I will tell you is if you do choose a mentor, listen to them. Do you know how many people hire mentors and then don't do what they tell them to do? It blows my mind, but it goes on every single day. I don't know why. That is, again, everybody has a choice here as to how they progress. I'm just a huge fan of compressing time. I would encourage anybody thinking about getting in this business to consider doing that, whether it's with us or somebody else, doesn't matter. The only thing I do want you to do is make sure that whoever you learn from, this is really important. Make sure that they have actually bought deals, ran them, and gone full cycle with them, right? Because anybody can buy a deal, but you want to know that your mentor has sold them and made money. Like they've done exactly what you want to do, right? Don't just let it go part way, okay? So, whoever you pick, just make sure they got a good long track record and they've done it full cycle. That's super important to me because now they proved that they did what you want to do.
Yeah, absolutely. Very, very good point. On that, we're going to take a quick sponsor break and then we'll be right back.
How do you build a company that lasts? One with a solid foundation that gets better with time, transforming the first dollar in your bank account into something more, building a product, a team, a culture, expanding to new countries, currencies, and customers, and accessing the capital you need to grow. How do you do all of that? With powerfully smooth banking that keeps you focused on bringing your vision to life.
So we're talking to Ken G of KRI Partners. We certainly appreciate it. And Ken's given us some good information today as it relates to the multifamily space. And but one thing I wanted to, you kind of touched on this as well, I kind of want to make sure that this point is really driven home, is you mentioned about vetting operators and investment firms And, again, what was that point straight before the break? If you're going to vet somebody as who you're going to do business with, what's the one thing that you want people to understand as they come away from this session today?
Yeah. So if you're passively investing or you're hiring them as a mentor, you really kind of want to look at the same thing. So I have 4 rules I want people to follow. The first is they got to have experience. We talked about that a little bit. The second thing is, and the reason is the most important thing, right? You don't know what's coming next. These apartment buildings are businesses. We didn't know COVID was coming. We didn't know high interest rate was coming. We didn't know high inflation was. We just didn't know. So you got to have a management team that is good enough and has enough experience to figure out how to navigate that. Number 2, they got to have a track record. We talked about that. Going full cycle on those deals is, I think, really, really important. Next thing, they need to be transparent. Like, for example, our entire track record, we hired a third party to vet the whole thing and prove our numbers and audit it. It was horrible experience, but well worth it, right? So you need to know that they have transparency. And then the last thing is they got to put you first. You want to make sure if you're investing with them as a passive investor, you got to make sure, just ask yourself one question. Is it possible for them to do well and you not? Or if you're going to hire them as a mentor, how is it that you know that they're going to be there for you to see it through the process, right? Because anybody can sell you like a digital course and you can watch a bunch of videos. But taking, academia, I don't know if it's a word, I think it is, to real life, that's the key, right? Make sure that they're going to be there with you to help hold your hand to say, okay, I know the video said this, but this is what it means in real life. Right? So I kind of take those 4 rules and I can apply them to whether you're passively investing or hiring somebody to be your mentor. They kind of apply in both situations. I will tell you that what we find, if we look and talk to a passive investor and we forensically look at the investment they made, maybe it didn't go well.
Right.
We apply those 4 rules, and what we typically find is they probably broke 1 or 2 of those rules. And that's how I came up with those rules, because I mean, I can't give you a foolproof system, but boy, I can give you some rules that'll certainly put you in a lot better position than if you're not following them. So that's kind of how those rules were developed.
Yeah, appreciate that. So somebody, let's say they want to certainly be in a different position 10 years from now, with us recording this right now, we're starting a new year and everybody's like, all right, what am I going to do differently this year? Get better than last year. What would you say is the first step that somebody needs to take like right now in order to make sure that they're making that progression the way they want to be in 10 years?
Yeah. So let's assume that they want to go down multifamily. They have to decide. I mean, they know if they have money or not. If you have a lot of money, then consider going down the passive side. Still spend some time learning what you're investing in because that's going to serve you well. Alternatively, figure out, hey, I want to be the active side. I want to be the guy that sits in Ken's chair in 5 or 10 years and creates that kind of wealth for myself and my family. Just that's the first step, is figuring out which way. Now, believe it or not, most people go both ways. They start off passively investing a little bit, so they're learning as an investor. They get to see that side of the coin, and they're learning the business at the same time. And then set yourself goals. Write down your goals every single day, like literally every day. Seems kind of ridiculous, but what happens is life is going to throw a million shiny objects at you. And what happens is it's easy to latch onto that shiny object, right? But if you write down your goals every day, that reminds you every day why you're here, what you're focused on. And then you can ask yourself, wait a minute, does that shiny object help me get to my goal? Right? It kind of keeps you on target because people tend to, it's human nature to want to, oh, if I do that, I can make a lot of money right away. Well, that's a shiny object. And then there's another one over here, and then there's another one over there, and they're everywhere, right? And then you realize you kind of jabbed at all these things, but you never got anywhere, and you nowhere closer to your goal. So set that goal, write it down every day, and just stay focused. Just stay focused.
Yeah. It's interesting. I used to compare it to a person always trying to jump on the next horse to get further along. And anytime you jump on one horse, the other horse has to be a little bit behind you in order to land on it, right? Because if it's in front of you, you're going to miss it. Then it's time you get dip and you're actually going backwards, so you're not making any progress. So
You got some good analogies, man. I like that's good. That's good.
no, I appreciate that. So let me ask this: so what markets do you invest in? Are you all over the country? Just certain parts of the country? Where are you at?
Yeah, the South mostly. I mean, we started out in Cleveland. We first 10 years we were in Cleveland, and then about 15, 18 years ago, we started in Florida, and we're trying to get into the DFW market now. So we're all over Florida and heading and anywhere in the South. We just want growth, right? We spent 10 years in Cleveland in a non-growth market, so we know what that looks and feels like. It's not a lot of fun. That's why we prefer growth markets because if people are trying to live wherever you're investing, there's a pretty good chance that you can move rents, right? Because people actually want the product that you have.
Yeah, yeah, exactly. All right, gotcha. And are you mainly, where you mentioned the Southeast, are you mainly doing it for your own portfolio, or are you doing it as co-investing at this point, or?
No, we're a
From
private equity
that
firm.
standpoint?
So it's all our stuff,
Okay,
but we put our money next to our investors' money.
okay, all right. So it'll be your deal, and they'll be coming into your deal. Oh yeah, as an investor in your deal. Okay. I mean, that's
We're the operators. Yep.
right. And most of your investors are pulling your money from where? Where are they coming from? How are you, getting
All over the place. Oh,
Okay.
we have athletes, we have district attorneys, we have what else do we have? We have rocket scientists, we have corporate America. I mean, it's really a diverse group of people.
Okay. Are you using 401k money, IRA money, or this?
Both. About a
Totally above.
most people don't know you can use your IRA to invest in multifamily passively,
Mhm.
and so about a third of our investors use IRA money.
Okay, that's why I brought it up. So
Yep.
yeah, appreciate that. What's the actual investment box that you're looking at these days?
Yeah,
So you're
we're
in big
looking
plus it out.
yeah, B plus or better, 75 to 200 units in growing areas, in growing neighborhoods that we think has a 2 to 300 in upside.
Okay, all right. And I guess I was going to ask how far from the CBD in certain markets, but that depends on the market because it could be
How far from what?
from the central business district.
Oh, it depends. Yeah,
Yeah, it depends. That's what I'm saying. Yeah,
yeah, yeah.
city could be different.
Yeah, I mean, like, for example, we've got property in Winter Haven, Florida. You're like, "What? Winter Haven? That's a tiny little town," but it is halfway between Tampa and Orlando, and those 2 cities have grown together and bringing Winter Haven with it. Now, Orlando is growing into Daytona. It's all along I-4 in Central Florida. So we just bought a property about 30 minutes outside of Orlando, but right on I-4. Brand new deal. Literally, you could throw a stone to I-4 from that property. So we want to be in the path of growth, but I mean, obviously the best scenario is to be in that metropolitan area. We're in Tampa, St. Pete. We just bought a deal in St. Pete, 100 units, infill area. Like you can't get any more dense than that. Brand new deal. So it again, I go back to that discipline, that upside, that we know what we're looking for, and we do the necessary homework to know that we really do have that opportunity, that upside.
Sure. No, sounds good. Sounds good. So, in closing out, what would you want our listeners to leave with today? Most of them are in the commercial real estate space in some aspect, and that are here for education. What would you want them to walk away with today to keep in mind on this
Yeah.
conversation?
Yeah. So if you are somebody learning this business, go find a mentor, whether it's us or somebody else. Don't do this the hard way. You don't have to anymore. If you're experienced, I would say just make sure you don't get yourself FOMO, right? Because it happens.
Yeah.
It just does. And even experienced people have to fight off that disease. And yes, it is a disease. So that's the thing I want people to know. And I would say the last thing, I mean, when I started, I didn't have 2 nickels to rub together. I'm telling you, people figure this out. And they're not unicorns, right? A lot of people figure this out. If that's true, which I know it is, that means you can figure it out.
Yeah.
Just figure it out. And if you're not sure how, go find somebody that does know how and ask them. Because most people, like at my point in my career, I want to help people figure it out because it's completely changed my life. Like I was working like a dog as a CPA. It's changed everything. There's no way my life would be like it is had I stayed on that path. Nothing wrong with being a CPA, but it's a tough gig, man.
Yeah, yeah, absolutely. Well, I certainly appreciate that. A lot of, yeah, no, I was saying I appreciate those comments. It's a really, really good example, and to help people to understand that they can jump in. They don't have to start with single family. That's one thing that I always try to preach all the time is don't get hung up on that. And to really be, profitable and for it to make sense in single family, you have to own so many units. So you might as well buy an apartment building. So you're not dealing with, 1,400 roofs, all the other stuff that comes along with it,
You're right.
It's just a better way to do it. So, we certainly appreciate that. Well, Ken, I think it's been outstanding. Was there something else? Looks like you were about to add one other point before we.
No, I'm good, man. I'm good. I just want people to do it. Just go do it, man. Don't let anything stop you.
Gotcha. Where you based out of again?
Well, right now I'm in Cleveland, but as I said, everything we don't, our back office is in Cleveland, but we don't do anything in Cleveland anymore. Everything we do is in Florida and soon to be DFW market.
Okay. All right. Gotcha. All right. I was going to say next time I'm in that area, I'll stop by and we'll grab lunch together or something.
I would like that.
Got to make that happen. Yeah.
All right.
It's been a pleasure. So, Ken, thank you so very much. And for you guys listening to us, we want to thank you again for being with us today, the Mornings with Joel series podcast. Certainly join us again for more insightful insights as to how you can build your commercial real estate career. Thank you so much and have a great afternoon.